Hello, ladies and gentlemen, and welcome to another free live webinar hosted by myself, David Kinley. And today we're going back to Introduction to the Financial Markets. So this is just basically a 101 guide on how the financial markets work and CFDs in particular that Orbex actually provide to our clients, and to see what the best trading outcome is for yourself and possibly making your own portfolio in that respect. So let's dive right into the action. I hope you like the glittery effects of the presentation. Let me know. Just one other thing before we start as well. Just want to let you know that any live questions that you want to answer whilst I'm going through the presentation, feel free, as obviously audience participation is always, well, I'm always glad to answer any questions live on the air. So what does the market mean? Well, the market is a place where traders buy and sell different instruments. Economists refer to it as a mechanism between the buyer and the seller of different types of products. Buyers and sellers want to make profits from their decisions naturally and avoid losses at all costs. Financial markets, on the other hand, is a place where the buyer and seller conducting the transactions of the final assets look to make profits on price differences. So this is where CFDs kind of come into play, and we'll have a live look on my MT4 demo account, which I'll just bring up now at the moment. So I've got a demo account with just under $30,000. Unfortunately, it is a demo account for myself, not real funds, but we'll look at some trades and look at some markets as well as we go on in the presentation. So with that being said, what types of financial markets are there? Well, with these kind of examples, we've got monetary markets, Forex markets, commodities, bonds, and equities. So if we just look at equities, for example, this is kind of like an investment in companies. Companies give out dividends or profits at the end to their shareholders. If the company does go under as well, no dividends and no loose funds as well. So it's a little bit tricky trading with equities, as it might not suit your particular taste. Bonds, these can come from government bonds or big financial institutions. They're not as risky as other options on the board, as most probably a government bond or big financial institution most probably won't go under or default. So there will be that kind of security if you are trading bonds. Also, we've got commodities as well. Commodities come in oil, gold, these kind of things. If I give you an example at the live trade at the moment. So this is gold. We'll just put it back onto, let's go to a 1 hour chart. No, let's go to a daily chart. So it's a little bit easier to see. And as you can see here, gold is spiking quite high at the moment. So commodities such as gold and oil are have been moving quite significantly due to the Ukraine and Russia crisis. And this big move to the upside here is when the war did start, the invasion did start, sorry. And then we've had a bit of a move downwards because we've had sell-off pressure and also the hopefulness that there will be an end to the war as well. Same with oil. Oil we look at the moment, I've got it on the 1 hour chart. Let's go back to the 4 hour chart. So as you can see here, big moves in the oil market due to the fact that the supply and demand of oil could be weakened because of the Russia-Ukraine conflict. Then we had a big move lower because of the hopefulness that the invasion will start coming to an end, but it didn't. So as you can see, at the back end of March, we had another move to the upside in that respect. So this is how we trade commodities. Commodities are very driven with big geopolitical moves in the market, such as the Russia-Ukraine crisis, which is going on at the moment. So very big swings in the market. So if we're trading this, naturally, we're expecting another move to the upside. Oops, got the wrong arrow out at the moment. So we're expecting another move to the upside and possibly test these recent highs here. So this is due to the fact that oil naturally is going to become more expensive, which it has been doing across the globe, because Russia, which is one of the biggest deliverable countries of oil in the world, is obviously under big sanctions at the moment. So this is why we look to trade that as well. So these are just things to take into account. And Forex as well, the biggest market out there for most of these particular types of financial markets. Forex is traded quite significantly on a daily basis. So we are looking at that And let's just see what that actually means though. So the Forex market in general, what is it? So Forex is an abbreviation of foreign exchange, which means trading different foreign currencies. The major markets that investors trade with are the US dollar, Japanese yen, and British pound, to name a few. So we've got a few others as well that we look at. So back to the MT4 platform, if we go through our Forex pairs here, naturally, the biggest ones are usually at the top of the list. So euro against the dollar, pound against the dollar, New Zealand dollar against the US dollar, US dollar against Canadian dollar. So these big countries in the world that are obviously, you know, big with their gross domestic product, big with exports and imports. These are always moving all the time. So if we look at the euro dollar chart from today, we'll go back to a 4-hour chart, which gives us a bit of a clearer picture. So I'll just move some of these drawings for you. So as you can see here, big moves in the market, and this is usually due to the fact that it's traded very, very spectacularly every day, actually. So the euro dollar, pound dollar as well, cable, as it's often currently known as well. So let's get rid of some of these, just it's a little bit easier to see. Cable, on the other hand, as well, we're just looking to see these big moves in the market. So this is what we look for when we're looking for the big moves and the big foreign exchange pairs in the market. It's important to note the foreign exchange market operates on 24 hours a day, 5 days a week, with Saturday and Sunday being when the market is closed. It's when the market takes a breather. The Forex market is the biggest and most liquid market in the world, with a daily turnover of $5 trillion. So what does that mean in regards to the amount of money that's put into the foreign exchange market? Well, if we take a look at the next slide, it's quite interesting because we've got the New York Stock Exchange here, for example, the NASDAQ 100, which is a big, very big index in the American economy. But if you look at the total amount of Forex, which is trading, this is over 4 trillion. Obviously, we can go up to 5. But if you look at the New York Stock Exchange and the NASDAQ, it isn't really even a little blip on the map of what Forex is traded on a daily basis. So this is what I just wanted to point out, so you just get a general idea of how valuable and how popular it is for these big money markets and foreign exchange companies to be traded upon on a daily basis as well. So moving on, and it's also important to look at the sessions in the market. So we've got the Australian session, Asian, European, and American. These are the 4 big sessions that we that traders look out for and trade upon on a daily basis, depending on where you are in the world. We've just highlighted this in GMT time. So the Australian session will start in the evening GMT and finish in very early hours of the morning. So will the Asian session, pretty much the same, only a couple of hours difference. Then we go into the European session because it's the way the world is turning from right to left. We're going to the Europe, and then we go to the American session. America wakes up at the last time of the day. And then when America closes, then we start again with the Australian session. Now, why is this important to point out? Well, it's all about liquidity. And the best way I can describe it is if I can put this onto a chart. So I'm going to go by minute so we can see the full scale of what we're looking at the moment. So I'm dragging this chart back. This is today's chart, by the way. It's not, I'm not going back very, very far because I want to show you what the opportunities are and what I'm trying to show you. So we're going back at the moment. As you can see here, 10:35, 9:30, all the way back. So this is when the Asian session is starting, and it's when at the time of the rollover. Now, what is the rollover? The rollover is when the market closes, well, not closes, it goes from midnight to 1 minute past midnight on the next trading day, which is what we've got here. So we've got a weekend gap at the moment from the 1st of April to the 4th of April, but it works in the same way. If yesterday was a Monday and today was a Tuesday, then this would be, let's say, 3rd of April and the 4th of April. But you can see from the candlesticks, we've had, you know, some good candlesticks here, full-bodied, a little bit bigger than usual. Now we're coming to the thin liquidity. We've got gaps in the market. And as you can see here, these, I'll just zoom them in so it's a bit clearer to see. These candlesticks are pretty much non-existent, which means there's not much pricing And if there's not much pricing, there's not much liquidity. And that means there's not many traders in the market. So it can be very, very difficult to trade these particular times and minutes, because if you were to open a trade, the price might not even be there, because as you can see here, this particular candlestick or doji, whatever you want to call it, has not actually moved. And we've had a big gap in the market there. And then, as you can see, very, very small, thin candlesticks. So the Asian session, the early Asian session for GMT clients, traders, means that it's a little bit difficult to trade this particular time. And as we go into the trading day, we still see gaps in the market, because as you can see, it's 2 o'clock in the morning, 3 o'clock in the morning. Again, very small candlesticks, gaps in the market, not much liquidity. So it's a little bit easier, a little bit difficult, sorry. So for example, you wanted to probably open a trade at 110.428. As you can see, that price is not in the market at the moment. So what you'll see is you'll probably get an off quote. And what is an off quote? An off quote means when the price is not in the market, the trade cannot be opened or closed, and it will wait for the next available price in the market, which will be down here, which will be the minute after, and it will be right here where we had this next tick in the market. So it's important to note that during the Australian and early Asian session, we have very thin liquidity, which basically means that we don't have much pricing. And with that being said, you won't really get a lot of prices in the market. But as you can see, as we go into the trading day, so we get into 4 o'clock in the morning, 5 o'clock in the morning, you can see more and more fuller candlesticks, a few less dojis, and a few less gaps in the market. But as we go into, let's pull this out so it's a bit easier to see. As we go into the European session, you can see the big candlesticks. There's not much gaps, many gaps in the market when there is a close and open. As you can see, the market, this candlestick closed there. It opened pretty much straight away at the end. Again, we're seeing these candlesticks, slight gap there, but not too much, not too significant. And then of course, as we get into the full European and American trading session, which are the busiest of the trading day, you can see there aren't many gaps, and we are looking at all these full-bodied candles and big candles as well, as the news events come up and they shake up the foreign exchange market as well. So it's, as I said, it's important to note that these types of trading sessions are key when we are trading and looking at what the possibilities are. So just keep in mind, got the Australian and Asian session, which are the early ones. And then as the European session kicks in, when the European session overlaps with the American session, roughly about 2 or 3 o'clock in the afternoon, when the American session opens, it is a very full packed event, because you get all the American news and the European session as well. So this is something to keep an eye out for as well. So just moving on, as I said, any questions you want to throw at me, please do so. Always happy to help and to give a better understanding. So the advantages of trading CFDs in FX markets, foreign exchange markets. So we can buy or sell, we can make profits from buying or selling. We're trading 24 hours a day at 5 days a week, low spreads, very transparent. We trade on leverage, and it's instant market orders. So let's just take a look at what we're doing now. So let's just bring this back to the current time. So at the moment, with the European session is pretty much coming to an end, and we're in the full American session, pretty much 2/3 of the way into the American session. So at the moment, let's just open a small trade on euro dollar. So I've double clicked that, and let's just open 0.30, that's fine. So I'm expecting the market maybe to start moving higher, because we've hit a little bit of a bottom here. I'll put it on the 30-minute chart so it's a bit easier. So we're moving lower, but hopefully, I'm hoping that we will see a bounce and a move higher. And let's have a look, let's say on gold as well. So gold, I'll go back to the 30-minute chart. And what do you reckon, buy or sell? We could think that it's going to keep moving down and maybe test these areas here. Let's take out a sell position. And again, let's be a bit more adventurous and open a bigger amount here. So we're selling. And let's see how they're going to do in the next few minutes, in the next 10 minutes or so. So what I've done then is I've opened an instant market order, what would happen in the early Asian session if there was no move in the market, no price in the market, sorry, then I would get a off quote, and then the price would probably have to be opened again and again until I get my price. So that's the difference between opening something that when the trading session is fully open, and if the Asian session is making it so that my trade would cause an off quote. A good example to show you actually is if you go to a low liquidity pair. Let's just try the dollar against the Norwegian kroner. Open this chart. Let's go into the minute chart. Let's just see what we've got here. Okay, the example that I wanted to show you at the moment was when we have a low liquidity currency pair, then we usually get gaps in the market throughout the day, but that's not the case with this one. Let's try dollar Polish zloty. Okay, as you can see, there's some gaps in the market. Let's just try and open a trade, just a small one, just to see if it's going to open for me. And it has done. Okay, it's probably a bad example then. Let's try one more try. Euro against the Norwegian kroner. Another thing you can check, actually, just reminded me, if you go to the market watch and pull this to the side, just auto arrange, you can see the updated ticks here. So at the moment, we are being very updated. So Euro, Turkish lira, as you can see, the last tick we got, the last price we got was at, well, 1 minute ago. So that would be a good example to show you. As you can see, very, very difficult to trade because there's not many prices. And there we go, perfect example. So I've got an off quote, and this is because there's no price in the market until 1 minute ago. Now, this isn't a problem with the MT4 platform. This is because the actual currency pair is very thin, no liquidity, not many traders trading on this particular currency pair. So as soon as that updates to the correct time, I'll be able to open my trade because there'll be a tick in the market. But at the moment, as you can see, there is very, very thin liquidity, not much happening, pretty much no tick. So what you'll receive is an off quote. And to confirm that, you can go onto the journal here and you can see here. So by 0.01, that was my trade that I tried to put Euro Turkish lira opening at market, and it failed because I got an off quote. So this is like a confirmation on your journal that these are the correct trades that I've just all opened. So dollar Polish zloty, but as you can see, off quote and off quote again. But I'm hoping that as soon as we get the tick update, then we'll be able to open a trade. But as I said, just want to show you a good example of an off quote. And as you can see here, dollar Turkish lira as well, 8:17, and you can always just double check what the correct time is. So 8:20. So that's 3 minutes ago. So like I just said, just tried to open a dollar Turkish lira trade and it didn't open because of that reason. So, and again, so yeah, I just want to show you what the benefits are in that respect. So our gold trade is doing pretty good. We've, well, we were on $8, but now we're starting to sink a bit more. And our euro dollar trade is not doing too well as well. So as I said, this is what the big transparency is in that respect, because it's very, very transparent, because the MT4 platform is showing us, you know, sorry guys, that these ones are all updating, as you can see, 8:21. However, at the moment, we are stuck on the Turkish lira pairs. Oh, the euro Turkish lira has just opened. So let's just check that. As you can see, we've got a price in the market here. So now I should be able to open the trade, and I have been doing, because I've got an updated price Not that it's going to help me, because I won't probably might not be able to close it in a couple of minutes until I get an updated tick. But as I said, I won't keep going on because I don't want to bore you with the details, but that's just how the MT4 platform works and how we look at off quotes and ticks as well. So we've got another tick at 822. And as you can see, it's here, but very, very thin liquidity, very, very difficult to trade these types of currency pairs if we don't get updated ticks as well. So moving on to the next slide, what I want to also point out is the major traded currencies. So as I've just given the examples there, we've got the USD, the Euro, the Japanese yen, British pound, and the Swiss franc. These are very, very big pairs that a lot of traders like to trade on. Why is that? Because there's a lot of movement in the Forex market. The MT4 platform is usually moving quite a lot with these prices. And because as you've seen on the example, the Turkish lira wouldn't be a major currency, it would be a minor currency because it's not very popular and not traded upon quite often. Other minor currencies are Canadian dollar, Australian dollar, New Zealand dollar, Danish krona, Mexican peso, to name a few. As you can see on the MT4 platform, this is the South African rand, not so popular, the Swedish krona, Polish zloty, Norwegian krona. These are all kind of minor pairs. As I said, if we go up to the top, we've got the major pairs that are the first on the list, and these are the most traded usually. So we'll see how that's going to go. And the list is quite good because it gives the most popular ones at the top, and as you go down, it's the medium pairs. And by the time we get down to the bottom of the foreign exchange list, we've got the pairs that are, less likely traded upon. In the yellow, we've got the commodities, the gold and the metals, gold, silver, and if you just hover, you've got palladium and platinum there, and this is silver. And if you go down in the purple column, you've got the indices. So you've got the Dow Jones, the Nasdaq, the S&P 500, the German DAX, and the UK FTSE 100. And then if you go right to the bottom, you've got the oil as well. These are the orange ones are futures which have expiry dates. And we'll go into that on another session when we go into actually next week, where I'll be hosting my calculations on Forex, and we'll be able to go through all of these and all the calculations you see here. Why is my margin $288? Why is my margin level here? And how do we calculate the profit and loss based on pit values as well? So that's for next time. But for now, as I said, just wanted to show you the minor currencies as well. So Orbex does trade with currency pairs and not individual pairs. So the first pair is the base currency and the second is the quote currency. So going back to our MT4 platform, the Australian dollar is the base currency and the American dollar is the quote currency. So it's always a pair versus a pair. It's never traded alone because this is what gives it value and also gives it the reason why we move up or down. I'm going to move on to let's go on to the euro dollar because it's quite popular. So how is my trade doing? So I bought the euro dollar. It's going down a little bit, so it's not really so beneficial. My gold trade was doing very well. It was actually, as you can see, spiked down to this particular area here, but now it was starting to move higher. So I was down at 19.29. Hopefully it will keep going. I think $20 is making more money for me because I opened more of a lot size. But again, this is for another webinar, which will be next Monday on my calculations. So that will be quite interesting as well. So moving on to the next slide. And pair categorization. So pairs which the USD is the counter currency. So these are direct pairs. As I said, the popular pairs that the USD would be the quote currency. So euro, pound, Australian dollar, New Zealand dollar, just a few examples. And then indirect pairs. So we've got where the dollar is the base currency. So dollar yen, dollar Swiss franc, and dollar Canadian dollar. And then we've got cross currencies as well. So this is all other currencies where the dollar is not included. Now, we just want to highlight the American dollar because it's the most popular currency in the world when we're trading foreign exchange. So if it's got the American dollar in it, it usually does carry more opportunities and more weight in that respect. So if we're looking now at cross currencies, it's just the ones that are not included in the American dollar. So it can be very, very, yeah, depending on your portfolio as well. We'll see if that's going to happen and what's going to be in store. So moving on, and what we're looking at now is long and short. And what does long and short mean? So if we're long on a trade, it means we bought it, and if we're short on a trade, it means we're selling it. So if we see a bull market, which is a buyer's market, we're expecting the pair to go higher. So we execute a buy order on that pair, which means you buy the base currency and sell the counterpart currency. So, and for selling, it's vice versa. So what I've done here on my trades is I've bought the euro against the dollar. So I bought the euro thinking that it's going to be stronger than the dollar. So on the chart here, I'll put it back to a 1 hour chart. At the moment, what this leg to the downside indicates for me, it means that the euro is weaker against the dollar in this particular channel because it's moving lower. So at the moment, for 1 euro, I'm getting $1.09. When the chart was higher, I'll put it on the daily chart, going back to September last year. As you can see here, it was worth 118. So this means that for every 1 euro, I could get $1.18. So that means the dollar was weaker at this time. But now we're moving downwards. It's an indication that the dollar is stronger than the euro. And because I bought it, I'm expecting the euro to be higher. Here, I'm selling gold against the American dollar. So I'm expecting gold. I'm expecting the euro, the American dollar to be better, more value than the gold. And then I'm buying these two other currency pairs. So I'm expecting the US dollar to be stronger than the Polish zloty, and the euro, I'm expecting it to be stronger than the Turkish lira. And as you can see in my results, it's not going too well for 3 of my trades, but for one of my trades, my gold trade, it means that I am looking very good at the moment. So the other thing I want to show you is when we are opening and closing trades, why do we have a bit of a deficit when we are opening and closing? Well, what I want to point out is that when we open a sell position, we open at the bid price. And when we close it, we close at the ask price. Now, where are these prices? Well, the bid line is always visible on the screen unless you want to take it off. Now, the ask line is found if you right click, go to properties, and then click here, show ask line. So at the moment, this ask line and bid line are moving in tandem, but there's a gap in between, and this is called the spread. And what happens is, what are we on now? Euro against the dollar. So euro against the dollar. So what's happened on my trade, it means that at 1.09733, I opened the trade. And because it's a buy position, it opened at the ask price, and which means I opened it at this price and it's going to close at this price. So I'm going to give you a live example. I don't really mind too much about my trade. So let's just close these trades for now. Let's realize my profit. Okay, that's a good point. So euro, Turkish lira, why can't I open it? Why can't I close this? You hear the noise. It means that because there's no ticks in the market, there's no pricing at the moment, at 12.22, there hasn't been a price for 9 minutes since we last looked at it. That's why I can't actually close this particular trade. So that's what it means in my position. So let's just see my trade here for euro against the dollar. So I'm going to open a sell position. The market's moving lower. I'll just open a small amount just so we can see it. So as you can see here, the sell position, let's zoom in. The sell position has opened at this price, which was the bid, and it's going to close at the ask price. So I'm not going to make a profit on my sell position until the bid price has gone. And now I am making a profit. because what's happened is we've opened at the ask price, which is the red line, and now I want to close at the bid price. If the bid price was above my open price, then I would be in a minus. And as you can see, I've just put it back a little bit. So let's just try and close my Turkish lira. Oh, my Turkish lira trade closed. Let's just quickly go back. So as you can see here, Euro Turkish lira. Where did we go? Ah, there we are. So there you go, 831, 832. So we just literally found a price in the market, and that's why I was able to close the trade. So going back to our euro dollar trade, as you can see here, I'm going to close the trade, and because it's a sell position, it's going to close at the ask price, which is the red line. There's not much difference at the moment. So it's quite a bad example. So I'm going to go to, let's go to dollar yen. So it's a little bit easier to see. Where's my dollar yen? It's here. So again, let's open a sell position. It's got to be a bit more adventurous. Sell. So put it on the 1 minute chart. Again, I have to open the ask price. Show the ask line, sorry. And what's happened now is at 122.76, that's where my trade opened, because that's where the ask price was at the time. If I open a buy position, then it would open at the ask and close at the bid. So it's an opposite way around. So sell positions, we open at the bid, close at the ask. And for buy positions, we open at the bid, open at the ask and close at the bid. So it's very important to know that when we are trading. So a lot of traders wonder why the MT4 platform or trading in general has two different prices. And this is how the Forex market works. So we open at the bid for a sell and close at the ask. And for a buy position, we open at the ask and close at the bid. So now when I close my trade for the dollar yen, let's quickly go to the account history and see my dollar yen trade. Custom period, let's just do today. So my dollar yen, we close at 122.76. And that's because the bid line was at 1.22.761. So that's the reason it didn't close at the ask line. It opened at the ask and closed at the bid. So let's just do another one quickly. So the ask is 122.77 approximately. So we're selling, and 1.2.766. Because it's a sell position, it opened at the bid. As you can see, it's just moved away from the bid line. And when I close it at the ask, when I close it, it's not going to be the same, because it's going to close roughly at 122.77, which is there. You can see it in the price. So that's why there's a difference with the price, open price, and the close immediately, is because of the bid and ask. So it's just important to remember when you are trading. It can be very, very beneficial. And it's also good when you're setting your pending orders as well, which we'll look at in a second. Just want to take you through the next slide as well. So pips. So a pip is the minimum fluctuation in the price, and is the quote of the price quote of the currency, and it's abbreviation of percentage in points. So let's give an example. So if the dollar Swiss franc price changed from 0.9300 to 0.9301, it means the pair has gone up by 1 pip. Moreover, if the quote of the pound dollar has moved from 132.50 to 132.40, it means the pair has declined by 10 pips. So a pip is the fourth number after the decimal point. And then if we go into more pips, then this is 1 pip. This move here is 10 pips in this example. And then obviously if we went from 133.50 to 132.50, this would be 100 pips. So again, let's take a look on our MT4 platform. So euro dollar at the moment, let's freeze this actually, it might be easier. So I've frozen it. So We've got 1.09688 against 1.09691. So the difference between this and this is 3, and it's got it here as well, is 3 pips. We've got for pound dollar 1.31002 against 131.008. This is actually 0.6 pips, because what I want to point out is we've got 1, 2, 3, 4. So the 4th digit is 0. 1, 2, 3, 4. The 4th digit is 0. So then we move on to the next digit to give us more clarity. And this is actually known as a point. So the 4th digit is a pip. The 5th digit is a point. And what's the difference between that is 6. So this is 6 points. If it was 131.18, so let me just put my really bad handwriting, 1.01.08 against 1.31, 0. No, that's a bad example. So at 1.3118, just cross that out. Then the difference between that and this price is 10. So this will actually say 10. And what is 10? This is actually 1 pip, because we are on the 4th decimal. So these are pips. So it's just something to look out for. This is actually 6 points. And if it was more than 9 points, it will go on to 1 pip. So this would be 10 in that respect. So as I said, don't want to confuse you too much, but any questions that you have, please throw them at me if you want any clarification. Pips and points, coincidentally, we'll be looking at in the next webinar next Monday. So as we go on, we are now looking at the bid and ask. So like I just explained before, good example again, I froze the screen just to give you a live update, but as you can see here, these are some prices that are a little bit older because it's from a few webinars ago, but you get the idea. So 1.35919, 1.35937. So we've got the difference of roughly just under 2 pips there. So if you take the difference between 19 and 37, this will be the amount of points. So it's roughly, it says 18 points, which would mean 1.8 pips. Again, 1.15912, 1.15929. Difference between this and 29 and 12 is 17. So that would be 1.7 pips or 17 points. So this is just something else just to keep an eye out for as well as we go into trading and being comfortable with your portfolio, understanding what you're looking at as well when you're looking at bid and ask price. So just to recap, we're looking at the bid and ask. So with a sell position, the trade will open at the bid, close at the ask, and with a buy position, we open at the ask and close at the bid. So not to get to have full transparency, just right click properties and just show that ask line. So there's no hidden agenda from your MT4 platform. The bid line is usually always on the MT4 platform, and we are now looking at the ask line as well. So if I opened a sell position now, I'm going to open at the red line. It's going to close at the gray line, and vice versa for the for buyers as well. And the whole point of this is to make sure that you the trader is not just open and closing trades really quickly and trying to get profits. They traders will have to cover the spread, and this is a factor of working with the MT4 platform and also looking at what's how trading works in general. But as I said, any questions, feel free to throw them at me. As we close out the webinar, I've just got a few more slides left that I want to take you through. So volume is something that I get asked a lot about, and we take, as I said, it's all in a calculation that I'll go through in the next more thoroughly in the next free webinar that we've got next Monday. But basically you execute your buy and sell positions in the Forex markets by a standardized volume system called lots. A lot is a standardized quantity of any currency pair, which consists of the fixed quantity of the base currency. So a one lot, it is 100,000 notional value of that currency. Mini is 0.1 and a micro is 0.01. And this adds to the calculation as well. So I'll give you a brief calculation of how it's working. So if I want to do a 0.10, I buy that in the market. This is my volume. So I've opened 10,000 lots, 10,000 volume on this particular trade. And that basically all adds to the margin and also adds to the P&L as well. And also obviously is thrown in with leverage. If I wanted to open a higher amount, 0.90, this is 90,000. If I wanted to open 0.09, this is 9,000. So we've got 9,000, 90,000, and 900,000 if we go for being very adventurous there, opening a 9 volume trade. So that's just something as well, but it all ties into the calculations, which I'll go through more in depthly in next week's webinar. So again, I hope you like the graphics. Feel free to comment if you want me to change anything. I'll just touch upon leverage as well. Leverage is one of the reasons markets become available to all traders. It's a tool that allows traders to take big positions with smaller margin, which increases the risk and opportunities to the investor. So the type of leverage that Orbex offers ranges from 1 to 30 up to 1 to 500. And let's just have a quick look at a small example here. So if I open a 1 lot of euro dollar at 116 with a 130 leverage, so we're looking at the calculation, and this is the margin that we need. So it's 100,000 multiplied by the rate of 1.116 and divided by 30, which equals the margin requirement. So if we go back to the live trade here, get my trusty calculator out. And what I'm going to do is, so 10,000, which is our notional value. My demo account is fixed at 1 to 500 leverage. So I'm going to multiply by the price, which is 1.09722, as you can see here, and then divide that by 500. So as you can see here, 21.94 and 21.94. This is the margin requirement that I need to open a 10,000 notional value of the euro dollar trade at that price. So it's all calculated into an equation, and obviously the higher the amount of volume and the lower amount of leverage is, you'll need more margin. So if we go to the live example now, so 10,000 multiply by 1.09722 and then divide that, let's say, by 1 to 50 leverage. Oh, put a few too many. Divide that by 50 leverage, sorry. So I'll need 219. So it's kind of telling me that I'll need 10 times that amount, because my leverage has gone from 500 down to 50, which is 10 times more as well. So I've just got a live question. I know that a spread is a difference between bid and ask. So my question is, what is a bid and ask? And the same goes with the bank buy and sell. Just need enlightening on that. So my question is, what is a bid and ask? So basically, let me go back to opening a trade. So euro dollar. So if I go to buy a trade, as you can see, my trade is always starting on a minus. I'm minus 30 at the moment. And this is because, oh, I've gone into a plus now. This is because I'm paying the spread. So whatever way you open and close a trade, you are paying the spread first of all until the market moves into your favor. So because I bought euro dollar, it opened at the ask price, which is, oh, I'll go into the euro dollar chart. It opened at the ask price, which is here. But as you can see, because the ask price has gone above my open price, I'm in a profit. This is my open price in the green dotted line. The ask price is above. So the bid price is now above, because that's going to be my closing price. As you can see, the more it moves higher, this bid mark, this bid line, the more profit. I mean, there you go, boom. So it's moved up and now I'm in a more of a profit. If this bid line moved below, which it is going to do now, moves below, I'm going to go into a minus. So that's basically the difference with the bid and ask. It's with the ask, with the buy position, I'm opening at the ask, closing at the bid. So the bid has to be above my entry for me to make a profit, which it is doing now, as you can see. It's a very good example at the moment. So 0.10 is what I'm in a profit with at the moment. I can't zoom in anymore because it won't, the MT4 platform won't let me. But as you can see, once the bid price moves higher, because I'm in a buy position, then I'm going to be in profit. So as you can see, it's hitting a break even now. So it's on 0, and hopefully it will move again. So I can give you more of an example. So there you go. And it's going to close at, as I say, the bid price. So sorry, the ask price, because I opened a buy position. So just to recap, sell positions open at the bid, close at the ask, and the buy positions open at the ask and close at the bid. So with that being said, just want to move on to the final couple of slides for the presentation, and just another brief look at what leverage is. So leverage, the trader takes a position in the market by any volume they desire, and then the broker Orbex allows the trader to take the position. However, it takes a margin for that volume, like we just saw. And if we give 1 to 100 leverage, it means we need 1% margin for the total volume. After the trader closed the position, profit or loss, the broker returns to them that margin and subtracts the profits or losses. So just bear in mind that this is not a fee from the broker or Orbex. This is a requirement that you need in order to open the trade. So a perfect example. Now the bid has dropped below the price here. So I'm in a minus. So because it's a buy position and it's going to close at the bid line, the bid has to be above here for me to gain a profit. At the moment, it's not, it's below, and I'm losing funds. So that's a very good example here. So this gray line here is the bid. It has to go above this line here, at least here, let's say, for me to make a profit. At the moment, it's not. And if I close, let's just take a quick look. So that's my euro dollar, and 1.0968. So that's the last bid price at the time. And it's actually falling lower, so it's probably better that I closed it. So as I say, just keep in mind where your positions are going. So open at the bid and ask for sell positions. Bid opens at the bid, closes at the ask, and for buy positions, opens at the ask and closes at the bid. And with that being said, just want to take you through the two types of pending orders as well, because what I want to show you is there's two types of orders. It's pending order and market orders. And market orders are what we've been doing for the whole presentation, opening orders at the time. But pending orders, however, we have a different type of order. So pending orders are basically stops and limits. And what does this mean? Well, let's go back to our trusty MT4 platform, and I will just zoom out slightly. I want to just take this away and say that I can't actually be on my MT4 platform or on my application device with the MT4 platform on it. And I want to put in a pending order because I believe the market will reach a certain amount. So we open the trade. So I open the order box, got to pending order, and then we've got four options here. So we've got limits and stops. Now the difference between limits and stops is as follows. So a buy stop is placed above what the bid line at the moment, because I believe that the price here will be hit. Let's just take this last top here. I believe the price will be hit, and then we're going to keep on moving higher. So once the price is hit here at 1.0972, I believe the order will be activated in the market and it will start moving higher. So this is the purpose of a buy stop. A sell stop, on the other hand, works in a completely different direction. So let me go to a 30-minute chart because it might be a bit easier. So 30-minute chart, oh, let's go, let's just stick on the 30. So I believe that the market will move down to, let's say, 1.0950, a nice round psychological area here, roughly about here. And I believe that the market will hit 1.0950 and start moving lower. So that's when I'll put in a sell position, a sell stop. So the market will, the order will be activated here and then start moving lower. So that's the whole point of stops. We're hoping that the market will hit a certain peak or trough and then start moving higher or lower. So with that being said, let me just put that in. So let's just try them out. So pending order, buy stop at 1.0977. I'm going to place that. So there we go. So that's my, you'll see that a live trade, just open a live trade as well, just to show you something. So my live trades will be above and my pending orders will be below. And it'll say here, the type of pending order, my price, and what the price is at the moment. And when it goes green, it means that it is quite close to being hit. So just bear that in mind if the price goes green. That's a very good example there. Sell stop as well. Let's not forget that. You can obviously put as many pending orders as you want in. And we're hoping at the moment that at 1.0950, again, I've covered both my bases here, thinking that if it goes higher or lower, I'll be covered and my pending order will be open. One important thing here is you can't open an order too close to the market, because it says here, open price you must differ from market price by at least 5 points. So that's just something to keep in mind as well. And if you are making the mistake of putting a buy stop lower than the bid, as you can see here, if I put the same price in 1.0950 place, it's going to give me invalid, because a buy stop can only be set above the market price, the bid price, and a sell stop can only be set below. So at the moment, the bid line is at 1.0965. If I put in a sell position, sell stop, and I try to go above 1.0970, let's say, because it's above, invalid. So if you're getting invalid, you're either too close to the market or you're doing it the wrong way around. I'm only pointing this out because I've done it a few times in the past when I was training and getting involved in the financial markets, that I've gone the wrong way. And just briefly, just showing you sell stops, sell limits as well. Now it works a little bit differently to stops. A buy limit is placed below the bid line in the hope that, let's go to a different chart so it's a bit easier to see. A sell limit is, sorry, buy limit is placed below the chart in the bid line, in the hope that it will move lower, activate, and then start pushing higher. And then a sell limit works the other way around. It's set above the bid line in the hope that the price will hit and then will start moving lower. So it's a little bit confusing at first, but if we just close these pending orders here, so it's a little bit easier to see. I'm going to, so for cable, again, pending order, I'm going to go to buy limit. So I have to place this below the bid line currently. So where I had it currently, 1.3090, and there we go. So it's letting me open that because it's below the bid line. Again, if I try to do it above the bid line, 1.30, well, let's try 1.31 because it's above. As you can see, invalid because the pending order of the buy limit needs to be below. And let's just do one for sell limits. Again, this has to be higher. So where I've put it here, 1.3117, and it's let me place it because it's above. So just remember that buy stops are placed above the bid line and sell stops are placed below the bid line. And for limits, buy limits are placed below and sell limits are placed above. So that's just something to keep in mind as well. So thank you for your attention and joining me on this webinar. As usual, I'll be hosting the next webinar on Monday, where I take you through the important calculations of the MT4 platform, profit and loss, margins, leverages, pip values, point values, anything you can think of. And also going on into the April webinars, I'll also be trading with harmonics and also trading with Elliott waves as well for a beginner's guide there, and starting to see what the patterns are and everything. So with that being said, once again, thank you very much. Very exciting amount of webinars coming up. And I just got a quick question, another like question as well. When is the best time to exit a trade? Well, that's up to you. If you see a trade going against you, it's important to possibly put in the protective stop losses and take profits on the trade. In particular, my trade that I opened before, let's just close these two. The trades that I've opened while on the live session, as you can see here, these ones were just testing ones, but the gold trade that I opened, I saw that gold was moving lower. As you can see here, I saw a little bit of a support, so I wanted to close it roughly at 1930. It's a good psychological level as well. That is the best time for me to exit a trade. So that was more beneficial for me. And I've just been asked if we can get slides on today's lesson. Yes, of course. Please send me your emails if you would like today's session. Peter, who I usually contact with. Hi, Peter. Thanks for joining me again. Thanks. And I'll be able to send you everything on the slides in that respect. So it's got another question. When you explain about indicator and entry point, please elaborate. As I said, I'll be able to send you the slides as well on that as well. So let me know if you have anything that you want me to comment on. I'll be on the live on here for a little bit more longer. So please ask me your questions and I'll be able to answer them in due course. But as I said, got very exciting webinars coming up later in the month. They'll be advertised and they are Elliott wave basics and also trading with harmonics. Very, very good indicators to look for and to look out for when we're trading, because they can be very, very inspiring and attractive and makes you want to trade even further. So thank you for your emails, and I'll be able to obviously send you the slides there. So as I said, I'll keep online for a little bit longer to answer any questions you may have. Shadrach Joseph, yes, sure. Please send me your email address and I'll be able to send you the slides as well. So thank you once again, and keep your questions coming, and I'll be available for some time after this. Thanks again, and goodbye for now.